Hello everybody, welcome to my presentation. My name is Manuel Cukaj. I am part of the Applied Investment Management program at Marquette University, and this is my fourth pitch for the program. I am covering the international industrial sector, and today I'm going to present to you ZTO Express, ticker ZTO. When I was screening for a company, I was trying to look for a company that is counter-cyclical and is in an industry that benefits the impact we experience from the current pandemic. And the reason for that is because there's still uncertainty ahead because of Corona, of COVID, if there will be more lockdowns. So I wanted to look for a business that will benefit from those circumstances, but not do bad under improving conditions either. Besides that, I was looking for a company that is growing strong in the past and has good growth potential for the future, while also having superior profitability over their peers and competitors. ZTO Express is a express delivery company out of China, and in their business model they operate 90 sorting hubs and over 7,100 high capacity trucks, also smaller trucks, and they make up a total of over 9,000 vehicles. So the way the company works is that they only operate the transport between their own sorting hubs, and the transport of the packages from the customer to the sorting hub, which is called the first mile pickup or the last mile delivery, depending on if the package comes from the sender or is delivered to the receiver. This part of the transport chain is done by the network partners that ZTO works with. And these network partners are the ones paying ZTO for using the extensive network. So this business model is, compared to the direct customer-to-customer model, more scalable and more flexible. The revenue breakdown of the company is pretty straightforward, as it's almost a pure play company, I would say. They get almost all of their revenue out of China and Hong Kong, and just a tiny bit out of Macau. And their business segments also are divided into express delivery, freight forwarding, and accessories, while freight forwarding and accessories still are services related to their main operation. What are the drivers for growth of the company? First of all, it is market share expansion. So ZTO has a very impressive track record of steady market share expansion, from about 7% in 2011 to over 20% in current 2020. And they have good chances to further expand that market share. They just recently, during the pandemic, had the ability with their cash and funds that they saved up to invest further in infrastructure and buy about 2,200 new trucks and also new sorting machines and automating machines. And so now they're in a superior position than their competitors to capitalize on the industry growth and also the industry consolidation. And it is very likely or possible that they can even surpass their 25% market share goal by 2022. The second driver for growth is their cost leadership, or as I like to call it, cost leadershipping. Due to those investments, those high capacity trucks and also the sorting machines, ZTO has continuously been able to reduce their cost per parcel. So because of all this industry growth during the current pandemic, there is severe price pressure in this industry. But because ZTO was also able to lower their prices at the same time, they can sustain this price pressure pretty well and can survive the situation better than competitors. In the long term, this will help them as they gain market share, and then when the prices return to normal levels again, ZTO will capitalize a lot on those opportunities. And the third driver in general is the faster than expected shift to e-commerce. We've been seeing already a trend from brick and mortar to online retail, but driven by COVID-19 concerns, this increase in online penetration is growing even faster than expected. And As seen in China, retail sales were down over the last 2 quarters by -4%, -22%, but online sales were up at 4% and 20%. To evaluate, I used a 5-year DCF with a terminal growth rate of 2.25%. The WACC is pretty low because of the low beta and the countercyclical behavior of the stock. And that gave a target price of 41.73. I weighted that 70% and I used 3 relative valuation multiples, an EV to EBITDA, PE, and price to book valuation, and I valued them all at 10% each. This gives me a target price of $39, which represents an upside of 33%. Some of the major risks for this investment are the near-term uncertainties on pricing. As I mentioned, the price competition is pretty high right now, and it could go on for longer than expected, which would definitely weigh on margins and impact the company's results. Furthermore, as a Chinese firm listed in the US and the current situation between China and the US, regulation changes could impact the stock performance. And thirdly, capital expenditures could become less accretive in the future. In the past, ZTO success has been relying on the capital expenditures and improvements in innovation and automation, and it is never guaranteed that those investments will also be as beneficial in the future. Some important figures of the company: Mei Song Lai is the founder of the company and has been CEO since the company's inception. Lai Jianfa is the co-founder, and Huiping Yan is acting as the CFO of the company. Thank you very much for listening. I'm excited for your questions.